Sick of seeing your hard-earned cash vanish in taxes? Do you feel like you're missing out on some secret money-saving strategies that everyone else knows about? Well, what if I told you that by 2026 you could be saving thousands of dollars on your taxes? Legally, just by making a few smart moves right now. Stick around because in the next 10 minutes I'm going to break down the exact tax hacks that millennials and Gen Z need to know to keep more of their hard-earned money. We're not talking about complicated loopholes for billionaires. We're talking about simple, actionable steps you can start taking today. So grab a notebook because you're not going to want to miss this. First things first, let's talk about the elephant in the room. Retirement accounts. I know, 2026 feels far away and retirement feels even further. But hear me out. Contributions to a traditional 401k or a traditional IRA are made with pre-tax dollars. This means that every single dollar you put in lowers your taxable income for the year. Let us say you re in the 22% tax bracket and you contribute $5,000 to your traditional IRA. Boom. You just saved $1,100 on your tax bill for that year. It's like giving yourself an instant raise. The money grows tax-deferred, meaning you don't pay taxes on the investment gains each year. By 2026, those contributions will have seriously added up, not only building your future wealth, but also significantly cutting down your annual tax bill. Don't sleep on this. If your employer offers a 401k with a match, contribute at least enough to get the full match. It's free money, people. Now let's switch gears and talk about the Roth IRA. While a traditional IRA gives you a tax break now, a Roth IRA is all about a tax-free future. You contribute with after-tax money, which means no immediate tax deduction. But here's the magic. All your withdrawals in retirement are 100% tax-free. Imagine that. In your golden years, you pull out your money, and Uncle Sam can't touch a dime of it. For many millennials and Gen Z who are in lower tax brackets now than they likely will be in the future, this is a brilliant move. You pay the taxes now while your rate is low, and you enjoy tax-free growth and withdrawals later when your income and tax rate are higher. A great strategy for 2026 and beyond is to have a mix. Maybe you contribute to your employer's 401k to get the match and the immediate tax break. And then you also fund a Roth IRA for that sweet, sweet tax-free future. It's the best of both worlds. Okay, let's talk about something that's super relevant for our generation: side hustles. Whether you're a freelancer, a content creator, a delivery driver, or you sell crafts online, you are technically a small business owner. And that comes with some amazing tax perks. The key is to track everything. Every single expense related to your side hustle can potentially be a tax deduction. The portion of your internet and phone bill you use for work? Deductible. It's the mileage you drive for your delivery gig. Deductible. It's that new laptop you bought primarily for your freelance design work? You guessed it, deductible. Software subscriptions, home office expenses, marketing costs, it all adds up. By 2026, if you're not meticulously tracking these expenses, you're literally just throwing money away. Use an app, use a spreadsheet, use whatever works for you, but start now. Don't wait until tax season to try and remember what you spent a year ago. But treating your side hustle like a real business is the first step to unlocking major tax savings. Next up, a massively underutilized tool, the Health Savings Account, or HSA. If you have a high-deductible health plan, you need to listen up. An HSA is like a superpowered savings account with a triple tax advantage. First, your contributions are tax-deductible, lowering your taxable income, just like a traditional IRA. Second, the money in the account can be invested and grows completely tax-free. And third, when you withdraw the money for qualified medical expenses, those withdrawals are also 100% tax-free. It doesn't get better than that. This isn't just for doctor's visits. We're talking dental, vision, prescriptions, and even things like sunscreen and menstrual products now. The best part? The money is yours forever. It's not a use-it-or-lose-it account like an FSA. You can build up a significant nest egg in your HSA by 2026, creating a tax-free fund for any future health costs. It's a retirement account for healthcare, and it's one of the most powerful tax-saving vehicles available. Let's shift to something many of us are dealing with: student loan debt. It's a huge burden, but there's a small silver lining come tax time. You may be able to deduct the interest you paid on your student loans throughout the year, up to $2,500. This is an above-line deduction, meaning you don't even have to itemize your deductions to claim it. It directly reduces your adjusted gross income. It might not sound like a huge amount, but every little bit helps, okay? And it's a deduction specifically designed to help people paying off their education. As you make payments over the next couple of years leading up to 2026, make sure you get Form 10980 from your loan servicer. This form shows how much interest you paid. It's a simple, straightforward way to lower your tax bill while you're tackling that debt. Don't leave this money on the table. Now, a quick word on tax credits versus tax deductions. A deduction lowers your taxable income. But a credit is even better. It's a dollar-for-dollar reduction of the actual tax you owe. A $1,000 tax credit saves you $1,000, period. So, what credits should you be looking for? The American Opportunity Tax Credit and the Lifetime Learning Credit are huge if you're repaying for higher education for yourself, a spouse, or a dependent. There are also credits for clean energy, like installing solar panels or buying an electric vehicle. As we head towards 2026, tax laws and credits can change, especially with a focus on green initiatives. So, it's crucial to stay informed. A little bit of research each year to see what new credits you might qualify for can result in massive savings. Think of it like a treasure hunt, where the prize is your own money back in your pocket. Let's talk about capital gains. If you're investing in stocks, crypto, or other assets outside of a retirement account, you need to understand how they're taxed. If you sell an asset for a profit after holding it for less than a year, it's a short-term capital gain, and it's taxed at your ordinary income tax rate, which can be high. But if you hold that asset for more than a year before selling, it becomes a long-term capital gain. And it's taxed at a much lower rate, which could even be 0% depending on your income. The strategy here is patience. By simply holding your winning investments for at least a year and a day, you can significantly reduce the tax bite. Another pro tip is tax loss harvesting. If you have some investments that have lost value, you can sell them to realize a loss. This loss can then be used to offset your capital gains. If your losses are greater than your gains, you can even use up to $3,000 per year to offset your regular income. It's a smart way to turn a losing investment into a tax-saving opportunity. So, to recap the master plan for 2026, max out your tax-advantaged retirement accounts like a 401k. And an IRA use traditional for the upfront deduction and Roth for tax-free future growth. If you have a side hustle, track every single business expense like a hawk. If you're eligible, an HSA is a non-negotiable triple tax-advantaged powerhouse. Don't forget to deduct your student loan interest. Actively look for tax credits you qualify for. They're better than deductions. Finally, be strategic with your investments. Hold for the long term and consider tax loss harvesting to minimize your tax bill. I know this is a lot of information, but taking even one or two of these steps can make a huge difference in your financial life by 2026. It's all about being proactive instead of reactive. Don't wait until April to think about taxes. Think about them all year round as you make financial decisions. By doing that, you're not just saving money, you're building a stronger financial foundation for your entire future. If you found this video helpful and you're ready to start keeping more of your money, do me a huge favor and smash that like button. It really helps the algorithm show this video to more people who need to hear it. And for more content on how to build wealth and master your finances, make sure you subscribe to the channel and hit that notification bell so you never miss an update. I want to know, which of these tax hacks are you going to start using first? Let me know in the comments below. I read every single one. Thanks so much for watching, and I'll see you in the next video.